All right, well, I'm joined here with Guy today, our portfolio manager, and we wanted to take some time to explain what a stress test or a risk analysis is, as we often talk about that when we are chatting for the first time with someone. Let's really take a look at what you currently have in a deeper dive, not just what's the balances on the statement, what funds it in, but really what is behind all that. So we're going to take some time. I'm going to share a screen, and Guy will do most of the talking here, but we're going to go through and share a report that we did for some clients here and one that we do ongoing on what this really looks like. So a guy, I'll kind of hit this. This is the first page that we'll show, showing their holdings, but I know that they had a bunch of mutual funds, as you can see on there. And what this really does is breaks down into what those is really in those funds, correct?
Yep. Thanks, Michelle. And yeah, this is usually the first thing we like to do when, we're kind of taking a look at a portfolio, and it's essential when it's really just a list of different funds or ETFs, because in and of itself, you can't necessarily see the direct exposure within all these different funds. But when we put it into a program like a Morningstar here, it becomes very useful because we can put in the fund listings as they're currently laid out on the statement, but on the right side, that gives us a little bit of that deeper dive. It gives us then a breakout of the overall sector exposure, asset allocation, but then even geographically, where things are positioned. So in this particular example, once we were able to input the statement, it became very clear that there was a couple things that within this whole lineup of different funds and ETFs, that were kind of put together, that the overall positioning, was a little out of whack from where we would have things targeted. And the first thing that was really kind of jumping off the page to us was that, the domestic exposure within here was only 80%, which means about 20% of the portfolio was to international. A lot of it was more developed with Europe, but, also some emerging markets. And, but to us, 80/20, was out of whack from where we would want to be. We're much heavy. Our targets were much heavier to be more US, more domestic, for a lot of different reasons. So that was the first thing that this was able to kind of point out to us. And then secondarily, within all the different equity investments, we can see up here in the top right the sector exposure. And some of the things that jumped off here were, being a bit overweight to financials. Technology, even at 20%, was actually a little bit underweight to where we would want it. But then they were also very light on things like materials, almost no energy exposure, and discretionary was also pretty light there. So right off the bat, we could kind of clearly see that within this list of different funds, on the overall positioning and the underlying assets within the funds, there was places that we would want to reposition and kind of adjust things. So the next page then
Well, Guy,
shows.
real quick on this too. This also changes some. I mean, there's probably different times. I just want to be out there where, there was times where we wanted to be more, a lot underweight in maybe technology right after 2020, and have more in some of the energy. And so how you want these sectors to play out, and even maybe, geographic could be dependent based on what's going on in the world, correct?
Yeah, no, absolutely. I mean, with everything that we're doing from management standpoint, there's a tactical aspect to it. So that's always changing depending on the market circumstances, So these sector allocations, those are consistently changing depending on what we're seeing from the macro environment and, different themes and trends that we're seeing that could be better positioned for one sector versus another. But in general, there's certain things that we know that will change a certain percentage, but you know, being being only 80% to domestic was kind of a big one for us that we haven't been there in a long time. We're a little more sparse on the international, and that's where we would be kind of adding in where we see more opportunities. But even 80/20, we know from a long-term perspective was a bit out of whack. But you brought up a good point that there's the tactical nature, but on it, when we're looking at this, it's in the current environment, and those are certain things that we would probably want to change given the current environment at this time. But then the second page, when when we kind of stick it on a comparative analysis, um, this is looking at portfolio composition. This is basically us knowing that yes, over the years, there's going to be a tactical nature. We're going to want to be overweighted to certain sectors in certain environments, and then that changes, especially when things do really well and other things maybe become a bit more discounted. But that's why right on the top, what I think is important here, that we're using a 2-year comparison. We keep this short because when we're looking at this comparative analysis, it's looking at the current snapshot and then it's back testing it for 2 years. But we know in reality that, oftentimes you're buying or selling, or you don't have the same positions, for longer than 2 years. So that's why a lot of times if we're looking at it at 5 or 10 years becomes, not really realistic because you may not be holding these same positions for the last 5 or 10 years. So 2 years is a good snapshot because it gives us from the portfolio composition, how did this particular portfolio act given the types of markets that we saw. Um, so that's a good point on why we would use kind of a short time frame there.
Yeah, usually
Um,
2 or 3 years, right, is usually what we're looking at. So,
exactly. Sometimes the 3 year is good because, especially as of lately, because we've had a bit of volatility in markets. So it captures, we look at a 3 year, we can see a really strong market followed by a very poor market, followed by another very strong market. So we can get a good snapshot of how did it perform through those different market circumstances.
yeah,
Um, but if in this particular example, what the outcome is, on the left side, this is the current portfolio versus on the right side, this would be the proposed, or where we would have had repositioned it. And one of the key things is we're not adjusting the asset allocation necessarily. We're still kind of keeping it in this case just about 60% to stocks. But the outcome on below, you can see that a lot of these different risk metrics, how one acted versus the other. And then kind of going down the line, the first thing you'll notice is that the correlation risk went down. Now, that would make sense because we would be switching to individual securities versus, the funds that oftentimes a lot of those funds and ETFs are all holding the same types of securities. So the correlation within them is much stronger versus we have a portfolio that's diversified and holding individual stock positions. The beta on here, it's actually slightly less in the existing portfolio, but not by much. They're both about, 0.5%. So that would be the volatility you would expect in those portfolios being about half of the overall market, at a little over 0.5%. But then once we kind of go down into the net total returns, you can see that on the proposed side, those increased over the 2-year period. So the total return increased to a little over 15%, which would be 7% annualized versus, a little over 10% and a little over 5% annualized. I can tell you now, looking back, that's the impact of being overweight international stocks at that time. They were causing a bit of a drag. So I'm sure that was a big proponent of a little bit of that underperformance. So within this, you would be expecting to get, a bit of superior performance, but at the same time, there's a max drawdown here. So the next line under, you can see on a max drawdown, it's actually less on the proposed portfolio, just about 15% versus a little over 16%. So that means in one of the, in the worst scenario over the last 2 years, that was, the right portfolio was only down 14.99 versus 16.36. The volatility below that, once again, those are both right around 10%. That's just from a statistical standpoint. That's talking about standard deviation relative to the annualized return. So both of those being at about 10%, it isn't changing too much, but on the right side, you're working off of a higher average number that volatility will be going off of. So that's why at the very bottom, when you're seeing the Sharpe ratio and the Sortino ratio, both of those numbers increase slightly as well. And that would make sense because essentially what you're getting is better overall return with, less drawdown, less downside risk. So those ratios increase when you're getting more return for less risk.
Yeah, so
Um,
basically the Sharpe and Sorrento is the higher the number means you're kind of getting a better return for less risk, right?
exactly.
In
Yep. And
these terms.
there's a slight difference between the two of them. The Sortino takes less of a weight on the downside versus the upside, but essentially they're both meant to show the same thing. It's for every unit of risk you're taking, how much more better return are you getting? So the higher those numbers, the better.
All right, so yeah, this is kind of what it looks like. We can go into more detail when we do something individually, but the other thing I just want to mention out here is that the returns, people often ask about fees, which we'll have some other talks about that, but on the proposed side, which is actually a portfolio that you manage, that's why you see the exact dollar amount, and it's a portfolio that's being managed that just has the very same composition, but those are all net of fees. Now, on the current side, I mean, we can take into account sometimes mutual fund fees, but if there's any other management fees that are being charged, that's not usually taken into account. So I just wanted to point that out. You can correct me on that if we need, Guy, but wanted
Yep.
to point that
Yeah.
out.
Because sometimes it's not clear. I mean, so the expense ratios with the funds will be included in this, but if there's any type of management fee that the advisor is taking to put them into the fund lineup, unless that's clearly stated, that wouldn't be included into these results.
So yeah, so when someone says, "Hey, I'm going to pay you maybe a higher fee, or at least a more transparent higher fee than I'm current paying," then you want to know, am I getting a better result? And that's one of the reasons why we do this too. So anyway, well, that kind of a short summary. If you want us to do this for your portfolio, we always say having clarity is key, clarity in what you have and if or why you should make any changes. And so that's one of the first things we'll offer to do is just a kind of a stress test or risk comparison. So let me know if you want to do this for yours and we can talk through these in more detail. Thanks, Guy.
Thanks, Michelle.